Hey everybody, Jeff Garber, mortgage expert. Hey, I got two pieces of good news today. One, let me start with the loan level price adjustment. Basically, the rule that everybody got really upset about 2 weeks ago when the media blasted out all kind of misinformation about rates being higher for people with good credit, and then people with lower credit were getting, a break on how much it would cost to get rates. There was one rule in there that we really didn't like at all. And one of the rules was that if your debt to income ratio is over 40%, all right, there would be another hit to rate. So regardless of your credit score, if your debt to income ratio was over 40%, and debt to income is basically, we look at your total mortgage payment plus all of the other minimum monthly payments that are on your credit report, like car loans and student loans and credit card payments and installment loans. We add all that up and we divide that by your gross monthly income and we get a percentage. And typically, if you're around a 40% debt to income ratio, it's a relatively good sign that you should be able to afford the loan with no problem. And so the FHFA, who came out with this rule, had also put that clause in that if you're over 40, there was going to be an additional 0.375% cost in price to get a certain rate, meaning your rate would be either higher or it's going to cost you more to get the lower rate because of your debt to income ratio. Well, we were able to get them to kick that can down the road till August 1st, which was good news there. And we've just learned that now it's off the table completely. So the bad news is we still have the loan level price adjustments that we don't like. The good news is we are not going to be punished. Borrowers will not be punished for debt to income ratios over 40. So no additional cost there. Second piece of good news is we did get the inflation numbers. They came out today in the form of the CPI, which stands for the Consumer Price Index. And for the 10th straight month, the CPI came down lower on both the headline and the core. The headline is the reading that has food and energy in it, and the core is the reading that strips out food and energy. And we look at both of those numbers. But both numbers came down a little bit, even though it was only a little bit. We're still trending in the right direction with inflation coming down. It's been 10 months in a row. And if you're interested in understanding the relationship between inflation and mortgage rates, it's really easy. As inflation comes down, mortgage rates tend to trend down with them. And as inflation comes up, rates come up, as we clearly have seen. So we are expecting to continue to see this downward trend in inflation, which will give us some relief with mortgage rates as we get through the rest of spring, summer, maybe into early fall. We could start seeing some good things. That doesn't mean that we want to wait for rates to come down. Can't emphasize that enough. If you find a house that you want to buy and you can win the offer, I would take it, because if rates come down, as they come down lower, it's going to bring more buyers and borrowers into the market, which means there's going to be more offers on properties, and that's going to drive prices up even further. So if you see what you like, you want to get that today, you can always refinance later if rates come down. So you can get a house at today's cost, and then you can get tomorrow's rates later. So hopefully this helps. Hope you have a great day.